So I'd like to welcome Jerome Schneider from PIMCO. Jerome, Contessa just said something that I want to throw back at you, especially nowadays. You know, the volatility in the marketplace, and you're the noise in the background, is ramped up a bit. But I certainly wouldn't think that the Treasury market is necessarily a boring market. I think it's the same market. It's just something has changed. What do you think has changed?
Yeah, fundamentally what we're seeing is a higher cost of capital in the marketplace. Transitory mechanisms which really help to allocate risk throughout the market have fundamentally gone to a higher cost of capital, meaning bid offers are wider, functional markets are a little bit wider, and intermediaries want to make more on their capital. So what we're really witnessing is a recalibration from the low rate regimes we've witnessed for the past 10 to 20 years into a more normalized one, maybe one that we're familiar with in the 1980s and early 1990s as a result.
It's the Great Reset, and what you're pointing out doesn't mean the market's broken. It doesn't mean the market's flawed. It just means under the current conditions, big ranges are necessary.
Well, and investors have to adapt to it, and so they're going to think about it in terms of volatility in their portfolios, having longer holding periods, maybe even have a higher cash amounts in their portfolios. But fundamentally, from a transactional point of view, when you think about the world of liquidity and transactions, what we have to be recognizing the fact that the visibility out there is the ultimate cause as well. The lack of visibility is the ultimate cause of why there is volatility in the market. And until investors get comfortable with the shorter-sighted volatility or shorter-sighted visibility, then they're going to have to live with some volatility.
Everybody's talking about the Bank of England, and everybody is very critical of the Bank of England. Yet when I look at what they've done, here's what I see. I see a country that's still in a problematic, unique situation between COVID and Brexit, okay? And their debt to GDP is less than ours. It's what, 86%? And quantitative easing, while they were trying to do quantitative tightening, Christine Lagarde has the same play sheet. So very quickly, do you think the Bank of England ought to be singled out? Isn't this all coming home to roost because central banks subsidized rates for so long?
Ultimately, central bankers, banking profession has moved from being a dull profession to a dynamic profession. And what they're doing is ultimately being dynamic in trying to reconcile the inflationary expectations of the economy with fiscal policy, et cetera. So being responsive is what we should be expecting from almost every central banker around the world. Whether it's the right or wrong thing, time will tell.
They coordinated when they were all going down to zero.
Right.
But the multi-speeds, whether it's Europe, whether it's Japan, who's out in left field, or it's the U.S., they're never going to be able to coordinate with the upside.
But the pro-cyclicality is a very different situation at this point in time. And so when you think about it from the timing perspective, we are playing different games and different innings of the event. So when we think about it right now, the U.S. is in a very different situation, perhaps later in the game than the Eurozone as well as the Bank of England. And the situation that's being dealt to them is going to have to be dealt with a variety of different factors. Hence, the inflation-fighting powers of the Fed might be viewed in a very different lens than those of the Bank of England.
All right,
or even
let's ask the
ECB.
only question that viewers want to know. But let's whisper, okay? Like the president. What do you think inflation is going to be 1 year from today?
So you're going to see inflation gradually come down from what we see over this point in time. And I think one of the issues is that while we might not necessarily get to the 2% PC that the Fed is going to be, quote, comfortable with, what we're going to see is that trajectory moves slower. However, it might take a little bit longer than people expect, which ultimately means that front-end rates in the U.S. might have to be a little stickier than people would expect.